Okay, let's unpack this. We've all been watching, right? Just staring at Bitcoin stuck in this really frustrating tight band, just consolidating between what, $87,000 and $89,000.
Mhm.
It keeps knocking on the door of $90,000, but it just can't seem to punch through. And if you're watching this day to day, it feels like absolutely nothing is happening.
It really does. It's the definition of a structural transition. And you're right, that $90,000 mark has become this huge psychological and technical line in the sand.
Right.
But, beneath this surface calm, there is a tremendous amount of institutional and internal stress building up. So today, our mission is to cut through that quiet price action.
Okay.
We want to look at two massive defining forces. This complex institutional pivot, which is, capitulation of traditional finance we've been waiting for,
Yeah.
and the growing governance paradox, which is stress testing the whole decentralized system itself.
That structural framing is so key because when you look at the source material, the dichotomy is it's striking. Let's start with section 1, the great divergence.
Let's do it.
We have Wall Street heavyweights finally moving in, while the largest corporate accumulator Bitcoin on the planet seems to have suddenly just stopped buying. I mean, this is where the strategy gets really compelling.
Exactly. Let's take the institutional side first. JPMorgan Chase, the largest U.S. bank, is reportedly finalizing plans to launch a dedicated spot and derivatives trading desk.
A full desk.
A full desk for digital assets right within its markets division. This is a massive watershed moment.
I have to pause on that. Wait, this is the bank whose CEO, Jamie Dimon, famously dismissed crypto for years and years. So this isn't just some pilot program. This is a full-on trading desk. What's the strategic advantage for them to do this now?
Yeah, it's pure, hard-nosed commercial competition. And, it's driven by regulatory clarity. Their biggest clients, the hedge funds, the major asset managers, they're demanding bank-grade execution.
They want the same tools.
They want trade crypto in the same environment with the same compliance as their foreign exchange or commodity contracts. And the key here is the regulatory side. The OCC is signaling openness to riskless principal transactions.
Okay, can you just unpack riskless principal for a moment? Why does that one phrase matter so much to a bank like JPMorgan?
It's the golden ticket. It really is. It means JPMorgan doesn't have to hold these volatile assets on its own balance sheet. That minimizes regulatory capital requirements. It minimizes shareholder risk. They just act as the instantaneous matchmaker between a buyer and a seller, and they collect a nice fee for providing a super fast, compliant service. They're prioritizing fees over balance sheet risk. It lets them capture all this incoming capital without actually betting the bank on Bitcoin's price.
That makes perfect sense, and it also explains Wall Street's move-in. So now for the incredible contrast, MicroStrategy, the standard bearer for corporate adoption, we see they bought 0 Bitcoin, not a little. 0 for the entire week of December 15th to 21st, even though they had just raised $748 million.
It's incredible.
Yeah.
And that decision has ballooned their cash reserves to an astonishing $2.19 billion. But this is not a sudden loss of conviction. I think, as you pointed out, they are shifting from what was essentially a machine gun strategy, just constant buying,
Right, just spray and pray.
to a highly calculated sniper approach. They're waiting for the perfect shot for maximum efficiency.
But isn't holding over $2 billion in cash a massive opportunity cost, especially in a market that, most people expect to eventually break higher? Why park all that capital?
It's about treasury resilience and market mechanics. First, that cash acts as a massive psychological buy wall.
The defense.
Exactly. If we see a sudden flush, say the price drops to $80,000, they have all that dry powder to aggressively defend that level, signaling massive strength to the market. Second, it's a strategic defense fund. They can service any future debt entirely with cash.
So they never have to sell.
They are reinforcing the narrative that they will never have to sell a single Satoshi. And they're avoiding the price slippage you get when you try to deploy that much capital in a quiet, illiquid market. It's a very sophisticated defense against volatility.
And that sophistication makes MicroStrategy's timing look brilliant, especially when you contrast it with this painful cautionary tale we're seeing from the UK.
Oh, it's brutal.
A report detailing how 13 publicly listed UK companies are facing paper losses of over $100 million on their Bitcoin.
It is the reality check for corporate treasuries. These firms bought about 4,300 BTC at a staggering average cost of $113,105.
Ouch!
Yeah. With the price now near $88,000, those are deep, deep losses that pressure their core business. It just confirms that MicroStrategy's success isn't just about conviction, it's about their access to capital markets and their precise timing. For smaller firms, that kind of volatility is just an unsustainable liability.
Okay, let's pivot now to Section 2, market intelligence. Let's look at the immediate technical reality, because the charts right now are signaling some pain. We had that brief bull trap above $90,000, but the rejection was immediate and it was harsh.
And that rejection confirmed the short-term trend is bearish. We are consolidating, yes, but the technical structure is poor. Analysts have identified a bearish rising wedge breakdown on the 4-hour charts.
Which usually means?
It indicates trend exhaustion. It often precedes a pretty violent downward move. And to compound this, the daily relative strength index, the RSI, is sitting clearly below the neutral 50 threshold. It's hovering around 43.
So for listeners who might not be staring at charts all day, what does an RSI below 50 actually tell us about the market's momentum?
It's a clear signal that the sellers have the initiative. The momentum is decisively shifted to the sell side. Buyers are playing defense, not offense. And if you look at volatility itself, the 7-day volatility is near 2%, which is a historical low point.
Right, and we mentioned this in the outline. Volatility compression like this, it usually precedes a violent expansion. So what does that mean for the immediate outlook?
It means this quiet is deceptive. The market is coiled like a spring. When volatility gets this tight, a major price move, I'm talking $5,000 or more in one direction, is imminent.
And the odds favor.
Given the bearish structure and the failure at 90K, probability favors a resolution to the downside first.
And we're seeing that sentiment reflected very clearly in ETF data.
Absolutely. The U.S. spot Bitcoin ETFs, they recorded a net outflow of $142 million on December 22nd. That's the third negative day in a row. But, and this is fascinating, there's a divergence here. BlackRock's IBIT was the outlier. It actually recorded a $6 million net inflow.
So why is BlackRock still sucking up capital when basically everyone else is bleeding?
It's the nature of the capital they attract. This is what we call sticky capital. These are allocations coming from systematic model portfolios from wealth management clients who are positioning for the long term. They're less reactive to daily news.
So they aren't spooked by a little dip.
Exactly. While the fast money is flowing out of other issuers, BlackRock's stable inflow suggests that the institutional bedrock is holding firm.
Okay, so let's look at the supply side then, because this is where we might actually find the contrarian bullish signal you flagged, the hash rate decline.
Yes. This is a critical point, that the price action is totally masking. The network hash rate has dropped 4% over the last 30 days. That is the steepest drop we've seen since the halving back in April. This is textbook minor capitulation.
Now, minor capitulation sounds ominous, but why is it historically seen as a positive thing for the network?
Because it's the market thinning the herd. The less efficient, higher-cost miners are forced to shut down. Their profit margins just vanish because of high electricity costs or debt. And these shutdowns remove a constant source of selling pressure from the market.
So the weak hands are forced out.
They're flushed out.
Yeah.
And once they're gone, the remaining miners have lower costs and are much more likely to hoard the Bitcoin they mined instead of immediately selling it.
And the VanEck data backs this up, right? It suggests the worst of the supply pressure might be ending.
It does. Their analysis shows that buying during hash rate declines like this one has historically yielded positive 90-day returns 65% of the time. So for you, the listener, this means the current consolidation, especially if we dip lower, is happening while the conditions for a future rally are actually being reset. It means now is the time to be checking your long-term strategy.
Let's shift our gaze outward now into Section 3, geopolitics. We're seeing this sovereign divergence theme play out with incredible speed. Nations are actively competing to capture the crypto economy.
And Ghana is the latest example of a nation choosing compliance over just outright prohibition. Their parliament just passed the Virtual Asset Service Providers Bill, the VASP bill, for 2025. This formally legalizes and regulates crypto trading.
Can you just clarify what a VASP bill really entails, and why is Ghana taking the lead here in West Africa?
Sure. So VASP stands for Virtual Asset Service Provider. The bill sets up a really rigorous licensing regime. It implements robust anti-money laundering AML controls. For West Africa, this is huge. It provides a clear, compliant blueprint for banks and licensed operators to handle things like remittances. And the governor of the Bank of Ghana said, quote, "No one is going to be arrested for doing crypto."
It's a pretty clear signal.
It moves them from a regulatory gray area to a very attractive environment for foreign capital.
So that's about attracting capital. Meanwhile, on the macro stage, we have the BRICS bloc actively pushing capital away from the U.S. financial system. They offloaded $27 billion in U.S. Treasury bonds last month.
That volume is still pretty small in the grand scheme of things, but the direction of travel is undeniable. It just reinforces that macro thesis of Bitcoin as a stateless reserve asset. As nations reduce their reliance on the dollar, these non-sovereign stores of value, they just gain appeal. It's a quiet, steady macro tailwind for BTC.
And speaking of regulatory pivots, Tether, the dominant offshore stablecoin issuer, is now making a massive move toward U.S. compliance with their new USAT.
This is a colossal development. USAT is going to be a U.S.-compliant stablecoin issued by Tether America. It's a joint venture that includes Anchorage Digital, which is a federally chartered bank. This signals Tether's shift from, regulatory arbitrage,
Operating on the fringes.
right, to actively seeking regulatory integration.
Is this a genuine attempt at compliance, though, or is it just a calculated shot at Circle's USDC on its home turf?
It's both. It's absolutely both. They realize that to capture the next wave of institutional money, they have to have a fully regulated product. By partnering with a federally chartered bank, they're trying to instantly legitimize their offering and directly challenge Circle for dominance in that U.S. market. It's the ultimate maturation move.
That covers the external pivots. But now we have to turn inward. Section 4. Internal fractures. We need to address the volatility and the risks inside the crypto-native ecosystem itself. The Aave governance crisis. This sounds less like a policy debate and more like a full-blown civil war.
That's pretty accurate. Aave is the premier DeFi lending protocol, and it's facing this massive governance crisis. It stems from a contentious proposal to transfer core brand assets from the development company, Aave, to the DAO.
But the conflict seems to be about how the vote was actually pushed through, right?
Precisely. The proposal's own author publicly disavowed the vote. They allege Aave unilaterally pushed it forward during a low liquidity holiday period. And critically, critics also say Aave redirected swap fees, maybe $10 million a year away from the DAO treasury. It's the classic clash between the vision of decentralization and the reality of centralized developer control.
So for the listener, this raises a really big question. If a proposal's author can just disavow a vote, how robust is the governance in a DRO, really? How can something be forced through unilaterally in a decentralized system?
It exposes the fragility of on-chain voting. The vast majority of tokens, and therefore voting power, are often held by whales or founding teams. If the core developers control the timing and execution, they can effectively sideline smaller voters. And for any professional allocator, this dispute instantly creates a significant governance risk premium they have to factor in.
And that risk was realized almost instantly.
It was. A single whale dumped over 230,000 AAVE tokens, worth about $37.6 million, and it triggered a sharp double-digit price crash. That proves that governance failure is not abstract. It has immediate tangible consequences.
And yet, despite that fracture, we saw a surprisingly positive development. The founders of historically, let's say adversarial chains, Solana and Cardano, are signaling a détente.
Yes. Anatoly Yakovenko of Solana and Charles Hoskinson of Cardano publicly agreed to support developing a cross-chain bridge. They're calling it the WADA Sprint.
That's a big deal.
It is, because it signals maturity. It's a shift from that zero-sum, layer one tribalism to a positive-sum, interoperable future. It means Solana could soon tap into Cardano's huge holder base, making capital flow across the ecosystem way more efficient.
Okay, finally, let's quickly touch on the security landscape, because it remains treacherous. Chainalysis reports that the North Korean Lazarus Group stole a record $2.02 billion in 2025. What was their main tactical shift?
They pivoted heavily away from complex smart contract exploits to centralized services and social engineering. Their tactics are now disturbingly mundane. They embed operatives as IT staff inside crypto companies. They use fake recruiters to send malware-laden technical tests to job applicants. The risk is less about code and more about human vulnerability.
And for the individual user, Kaspersky identified a new strain of malware called Stilka.
Stilka is actively targeting browser-based wallets. So think Phantom, MetaMask, Coinbase Wallet. It spreads through pirated software, malicious game mods, and its only goal is to extract your seed phrase and private keys directly from your browser's local storage. This is a critical vulnerability.
So if your assets are in a browser wallet, you're essentially leaving your house keys in a floozy drawer, not a vault.
That's the perfect analogy. It just underscores the vital, non-negotiable need for cold storage if you hold any significant amount of capital. That endpoint compromise is now the most common attack vector. So what does this all mean for you right now? Look, the market is definitively in a structural transition. The bullish fundamentals we discussed, JPMorgan's entry, Ghana's clarity, the hash rate exhaustion, they're all building the foundation for the next major growth phase in 2026. But the short-term reality MicroStrategy's pause, the ETF outflows, these governance crises, it's all acting as significant friction, slowing down accumulation.
Essentially, this quiet period, this consolidation, it's actually a necessary transfer of risk. You have the weak hands, the stress miners, the retail investors spooked by governance drama. They're getting out. And the strong hands, the patient institutional clients using BlackRock and waiting for that JPM infrastructure, they're establishing their positions.
That's the takeaway. As you navigate the next few weeks, watch $87,000. That's your immediate support. If that fails, the market will likely test the structural support down at $80,650. That level is absolutely critical to hold to prevent a much deeper corrective wave. So capital preservation and operational security should be your focus right now.
And here is a final provocative thought for you to chew on. We just analyzed a whale sell-off triggered by a governance fight over Akai's centralized brand, while at the same time we're watching Tether launch USAT to embrace U.S. financial regulation. As this ecosystem matures and attracts all this traditional capital, is the true deep dive less about the technology and more about how much of its original decentralized ethos the market is ultimately willing to sacrifice for stability and institutional acceptance? Something to think about as you navigate this coiling market.